Hello, and welcome to another episode of ETF360. I'm Kirsten Chang, Senior Industry Analyst at VettaFi, and today I am pleased to be joined by Alex Petrone of Rockefeller Capital Management. Alex, thanks so much for joining me.
Wonderful. Kirsten, thank you for having us.
Absolutely. So Rockefeller just recently got into the ETF business. You've traditionally had a history of offering financial services to institutions, family offices, other high net worth individuals. So what led to the decision to jump into the ETF fray this year?
Absolutely. Our deeply experienced portfolio management teams have long managed daily liquid, open-end funds, separate accounts, but we pivoted towards ETFs really for a few key reasons. Certainly the added tax efficiency that you have, and then acknowledging quite clearly investors prefer intraday liquidity, the ease of use, the transparency that ETFs offer. This really wasn't an easy decision for us. Our SMID cap and global equity ETFs, those were conversions from GP LP structures. It's easier just to leave the status quo, but we knew that it was best for shareholders and clients to embark on that tremendous planning and work to convert. And our view was really simple. The ETF vehicle truly can deliver on tax efficiency and best outcomes for clients. And we saw that in week one, both for SMID cap as well as our global equity ETF strategy. On the municipal side of the strategy, these were new launches for us across three strategies: our national high yield and two state specific solutions, Cal and New York. And we opted for ETFs candidly because we wanted to lean in to the purpose of the asset class: tax efficiency. So there's really no better vehicle to drive that and deliver that within the municipal space than the ETF structure.
Couldn't agree more. So speaking of those muni funds, you recently launched an actively managed municipal bond ETF, right? The Opportunistic Municipal Bond ETF, ticker RMOP. That's been gathering assets. So tell us more about the fund and what sets this strategy apart from other muni-focused funds.
Yeah, absolutely. So when we think about the municipal market, deeply fragmented market, over 40,000 active issuers today, more than 50% of the borrowers are sub 30 million, many borrowers below 20 million. It's a retail oriented market, meaning a lot of individual investors here in the US that can create all of these opportunities when there's liquidity challenges in the market. So our view is really simple. Active makes a tremendous amount of sense in the municipal market. We brought in a deeply experienced team led by Scott Cottier, Mark Dimitri, Michael Camarella. They bring an average of nearly 30 years experience navigating the municipal landscape and really focusing on how to best optimize and seek to deliver on high tax efficient yields. We have a market that really historically, there's tremendous volatility, tremendous opportunity for active managers. We've seen that in the last 2 years, and we anticipate that will continue to be the case on a go-forward basis. So our fund is really looking across the entirety of the asset class, high grade, high yield, across sectors, across geographies, as we seek to deliver alpha to clients and just prioritizing that high tax efficient yield and a real lens towards bottom-up fundamental analysis.
Got it. So you mentioned tax efficiency, and you get that with the ETF wrapper. You also get that from the munis themselves. So apart from being tax exempt, why else might munis be so attractive right now?
Kirsten, you nailed it on the head. High tax efficient yields are absolutely the number one factor. When we look at the Bloomberg high yield municipal benchmark, it's yielding right around a 532 as of yesterday's close. That's nearly 9% tax equivalent yield for investors in the US that are in the highest tax bracket. Beyond that, though, credit fundamentals continue to remain resilient. We're past peak fundamentals, certainly, but state and local governments, they're sitting on healthy reserves. The overall macroeconomic backdrop remains positive for municipalities. Sure, there's hot spots, and our job is to identify those and certainly avoid them. But overall, we've found historically the credit quality of the municipal market tends to be on much more solid footing than other alternatives out there, and those tax efficient yields are quite compelling. I would add, as part of a broader asset allocation, historically low correlations to equities, both in the high yield and IG municipal market. So that can be a really key part of a US taxpayer's asset allocation, particularly at a point where we might say large cap growth PE ratios continue to climb to new heights.
And lastly, how should investors and advisors begin thinking about implementing these funds in a balanced portfolio? Should they think of it more sort of as a core strategy or supplemental?
I think these are complements. So when we think about our SMID cap strategy, for example, as I mentioned, when you consider the S&P 500, it is a tech heavy fund at this point with tremendous concentration. And when you look at high PE valuations and really a growth focus, we think it's prudent to diversify into small and mid cap strategies today, particularly with a focus on quality. And that's exactly what our mid cap fund seeks to do. On the municipal side, we believe our opportunistic municipal strategy is a core complement to a high quality SMA or investment grade fund for US domiciled tax paying investors. It can really serve as a key alpha driver in the municipal market to ensure that you're seeking best relative value across the entirety of the municipal market, investment grade to high yield, and really focused on that tax efficient total return through yield. And overall, we believe that investors will benefit in this environment through active management across key asset classes.
All right, there you have it. Thanks so much, Alex. That does it for ETF 360. My thanks again to Alex for joining us, and thank you all for tuning in to watch. We'll see you next time right here on ETF 360.